Hello. In this video, we will learn about the XNPV function in Excel.
When we use NPV, we assume that the cash flows are occurring at regular intervals like year-end. But as you know, cash flows can occur anytime during the year. So to be more accurate, we can use the XNPV function, which is an upgraded version of the NPV function, where you can handle irregular interval cash flows. So cash flows occurring at irregular intervals can be accommodated under the XNPV. Then the NPV calculation is more accurate. So the syntax is you give the rate like the NPV and the values, but in addition, you can give the dates or the exact days that the cash flows occur. So it's more accurate than the NPV function. So here we need to remember the cash flow dates. The first date listed must be the earliest. Other days can be not in chronological order, so they can be in random order, but the first date must be the earliest date. And XNP assumes the current date is the first date of the sequence. For example, if the first date is 30th August 2021, NPV is computed in August 30th, 2021 dollar terms. So the first date is the time zero and cash flows are calculated in terms of that date. So let's look at example. We got a 12% discount rate or weighted average cost of capital for this company. And these are the dates starting from 3rd December 21. So this is the earliest date. And these other dates can be in random order as well. So then we got the cash flows. And then we can calculate the net present value using the XNPV. So we write equals XNPV. And we need to give the rate and then the cash flow values and then the dates. So here you will notice we are giving cash flows from the initial date inside the XNPV. Like for NPV, we don't have to remove the initial cash flow at time zero from the function because XNPV is programmed so that it will properly discount the cash flows based on the date we are giving over here for each of the cash flows. So it doesn't matter if you put it inside the function, it calculates properly from time zero. So we got a XNP of 1.13 million here. So let's look at another project. Here the cash flows are the same, but the time here we are starting from 1st of January 2020. And notice all of the cash flows are occurring at the end of each of these years, 31st December. So in this case, we should get the same XNPV and NPV values because NPV is anyway programmed to do cash flows at year end like this. So let's try XNPV first equals XNPV. There's the rate and these are the values. And then we give the dates. And we get 676,000 XNPV. So then let's calculate NPV. So again, we give the rate. And here we need to keep the initial cash flow outside the formula. So we will give values from here, year 1. And then we will then add the initial cash flow separately, the normal way we do the NPV function. So here you will notice there's a small difference between XNPV and NPV. That is because XNPV uses the actual dates and discounts properly each of these cash flows, depending on the number of dates in each of these years. But the NPV function will assume each of these years are the same length with same number of days. So that's why we get a difference. But the actual value, the correct value is the XNPV. So always XNPV will be more accurate than the NPV function.
Thanks for watching.